Hey everybody, good to be here. My name is Brent Morse. It's time for Advanced Option Strategies. We've been going through this series of different option strategies. We're on week 5. This week, we're going to cover synthetics, long synthetics primarily, but we'll also talk about short synthetics as well. And we're just kind of building up, there's not necessarily a logical order for one strategy after another, but I'm trying to build up to some of the more basic strategies, and it seemed like a reasonable time for this. And I think whether it's a strategy you actually use or not, I think it's helpful to know in terms of your options knowledge. And I do encourage you to practice these strategies that we teach each week on your paper money account. That's what the paper money's for. By the way, in the chat, I just put a playlist link in if you want to check out some of the past strategies that we've done in this webcast. But there we go. Hey, let's move forward. Let me go through the disclosures and then we'll get to it. All right. Oh, by the way, I'm joined by James Boyd in the chat. Appreciate James, of course. And as you have questions, feel free to type those questions in. Between James and myself, we'll do our best to get your questions answered. And you can also follow us on X at BrentMooreCS, at James Boyd CS for additional financial content throughout the week. Now, remember, options do carry a high level of risk and are not suitable for all investors. And the material we go through today is for informational and educational purposes only. Look, we'll look at individual stocks, we'll look at individual trades. They're not recommendations. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Paper money software application is provided for educational purposes only. And all investing involves risk, including loss of principal. There's no guarantee that execution of a stop order is going to be at or near the stop price. And past performance is no guarantee of future results. We use technical analysis most weeks in this webcast, but just remember, it's not the only means of doing investment research there. So, having said that, let me just mention this. We got a lot of strategies. We've hit up a few of them, and we'll hit up more in coming weeks. So I'm looking forward to that. Here's the Thinkorswim desktop software. Thank you. I see a lot of familiar names out there in the chat. Appreciate you. Looks like, yeah. So there we go. So what is here's the market. The market's been going up. Okay, you guys know that. Doesn't really matter. I mean, here's the SPX. We could do the SPXEW, the equal weight, and it's not going to look that dissimilar, to be honest, because most sectors are doing pretty well right now. The trend continues up. At some point, the upward trend will change. At some point, it will break, but I don't know when that's going to be. And so right now, if you look at a lot of stocks, a lot of them are going up, and you may decide, hey, I want to buy a particular stock. And that's great. You may want to do that. This is an alternative strategy. This is called a synthetic because this is meant to kind of give you something similar to a stock purchase. It's not exactly a stock purchase, but it's meant to kind of mimic in some ways. And we'll talk about some of the ways that it differs versus a stock purchase. But when you look at it, the risk profile is going to look fairly similar. But keep in mind, if we do a synthetic, remember a synthetic is just a substitute for something, right? You get a synthetic oil, it's a substitute for I guess a natural oil. This is a substitute, but synthetics, if you do the option, you don't get the dividend. Okay, that's a difference between a synthetic and buying a stock. You don't have voting rights. That's probably a difference, depending on the class of stock you have, between buying a synthetic and buying stock. There's no expiration in stock. There is with options, which is what we're going to be doing. There's no assignment risk with stock, but there is with options. And so that's always something to consider. And the capital requirements are likely going to be different on these. And those capital requirements may differ depending on your individual situation on that. Okay. So, but here's what here's what I want to say initially about a synthetic. Number one, if we do what we call a long synthetic, and I'm just going to abbreviate SYN for synthetic. Okay. A long synthetic, it's a long call. It's a, put a comma, short put. Okay. Typically, we're going to do, that's supposed to be same. I didn't write that very well. Same strike and same expiration. That's a standard synthetic. Okay. Same expiry on that. So that's a long synthetic. And when we look at it, and we'll look at one in just a sec, it's going to look pretty similar to just buying the stock. Now, I already mentioned some of the differences between those two, but it's directional. So a long synthetic is bullish, and you would use it in circumstances similar to what you would do if you had say, a technical bullish signal you think on a stock, you may consider a synthetic. Now, a short synthetic is similar, not exactly the same, to short stock. Now, you'll notice if you watch our webcasts, we don't talk about shorting stock a lot. Why? Well, there's unlimited risk. There's higher, higher requirements to do so, margin requirements to do so. And similarly with short synthetics, you have a short call, okay? So it's going to have a short call and a long put. Well, that short call is going to give you a higher options approval level on that. So we don't talk about this that much, but it's similar to short stock. Again, same issues I talked about before. There's, expiration date. There's no expiration date on short stock and whatnot, but this is a way of doing it. And we'll talk about this more, but if you would do this, if you were more a bearish trader on this, okay? So let's just kind of look at an example here on this. Let me go back and just kind of illustrate. And I invite you to find stocks that you think are bullish and paper trade these. Here's what I'm going to do. I'm going to pull up Visa. And this is my thesis on this. You may disagree. It seems bullish to me from a technical standpoint. Why do I say that? Well, generally, when I'm looking at technicals, I think of trend. We've been trending up. This is a 20-day and a 50-day moving average, by the way. If you don't want to just look at moving averages for that, you can look for higher lows along the way. We've had higher lows. You can look at higher highs along the way. We've had higher highs. Trend is up. That's kind of the first thing. You can look for support levels. Yeah, I'd probably consider that kind of a support level. Okay. You can look at other things. You may have your own checklist of what's bullish for you. But if we're above a 20-day moving average, above a 50-day moving average, the trend is up. I'm going to call that bullish. Now, here's the thing with the synthetic. If it's meant to simulate stock ownership, then think of the ways you buy stock. There's different ways you do it. There's short-term investors. There's longer-term investors. You may have some technical things you look at on a stock. I just showed you a few technicals that I look at on a stock here. But you may also have fundamental analysis. In general, short-term trading, we're probably not focusing on technical and fundamental analysis as much. Longer-term trading, we're probably not focused. Well, longer-term trading, we tend to focus more on the fundamental analysis. Let's say we were looking at this for a longer-term trade. And can you do a longer-term option trade? Sure. Whether it's a leaps or just longer expiration or whatever, you can do longer-term expiration days trades. But if you're going longer term trades, you may consider fundamental analysis. And for that, you may go to the Analyze tab. You may look at some of these third-party research reports, for example. Some people don't care about them. Look, they get it wrong. There's no doubt. They're not endorsed by Schwab, but some people like to look at them. Okay. Uh, you may look at things like what's earnings been doing for me? Well, over the past few years, earnings has been going up quite nicely on uh, on Visa, which is the stock we're looking at. You may look at things like cash flow. Well, cash flow has been going up quite nicely on Visa. Sales, I won't just keep on repeating myself, but sales has been going up quite nicely. When you're doing fundamental analysis for longer term trades or longer term investments, often what we do is we look back at history, and those items that we want to be going up, such as earnings, sales, cash flow, we want to see those going up. Those things that we don't want to be going up, like debt ratios, we don't want to see those going up too much at least. And, there's no perfect stocks out there, but just realize when you look at this, you'll look at different things. You may look at things like, oh, here's my long-term debt. Okay, there's my debt. Almost every company is going to have debt. We don't want that going out of control or anything. And, that may be something you look at there. So this isn't going to be a long, I'm not going to go into super depth here in terms of our fundamental analysis on this, but just realize we do have other webcasts, such as growth and value investing, which James teaches, that will delve into the fundamentals a little bit more here. Okay. But let's say we're going to take a longer term stance on this. Then, if I'm doing a synthetic, what I'm probably going to do is I'm going to look for a longer term expiration date, right? If I'm doing a short term trade, I'm probably going to look for a short term expiration date. But I can go out as many days as I want on this. Sometimes people are reluctant to buy longer term options because they're time decay. If we just buy a call option, for example, the time decay, even though it may not be super high, the absolute rate of it may not be super high when you go out a long ways. Holding it for a long time, it kind of adds up. One nice thing about a synthetic is not only do you have a long call, you have a short put. Time decay is probably not going to be nearly as significant there. And we'll look at that again in just a minute here. But I'm going to go out a ways on this. I'm going to go out 307 days here. So this is the better part of a year. This is what we call a LEAPS option. And really, it's just a long-term expiration option, okay? For a synthetic, I'm going to go to at the money, 365. 365. There's our open interest on that if you're interested on that. We'd like to see more liquid type stocks, liquid type options. I'm going to click on the ask price. I'm going to go to the put. I'm going to control click on the bid price. That's our synthetic right there. Okay. Now, I'm on the trade tab. Let me analyze the trade. And I want to show you what I mean when I talk about it being like buying the stock. Let me just throw in a simulated trade here. Let me pull this up. So this is what the risk profile, we don't usually use risk profiles on stock. This is what the risk profile looks like for stock. The higher the stock goes up, the more money you make. Okay, the more money this goes up. Okay, the lower the stock goes against you, the more money you lose. Okay, at a certain point, this would hit zero, but that would be a pretty big point here. It would go down a lot. You know, once this hits zero, we'd be in a big major hole. So anytime you buy stock, there's potentially a very big risk. If you do a synthetic, there's potentially a very big risk. But do you see what this graph looks like? That's the first thing. That's what the graph looks like. Now, let me just switch this up here. I'm going to switch this. Here's what the synthetic looks like. Doesn't look that dissimilar, does it? It's pretty much almost identical. We already talked about some of the differences between stock ownership and doing the synthetic. But if you want essentially the same upside, taking into account this essentially the same downside for how much money? Well, the synthetic in this case, sometimes you'll get it for basically zero upfront cost. Okay. Doesn't mean there's zero risk. Okay. It doesn't mean there's zero risk. You still have the same downside risk on this. But the upfront cost, well, 100 shares of Visa would cost at $365 a share. That'd be $36,000 plus. Okay. How much would $36,000? The synthetic's going to cost you $1,000. And that's actually kind of an expensive synthetic, to be honest. But the price that you pay for the stock, this call, is largely going to be offset by the price you sell the put for. So that is what a synthetic looks like. So if the stock goes up 10%, well, we'd make, 10% on a 36,000, I'm kind of rounding here, 10% on a $36,000 stock would mean about $3,600 in profit. Okay. A 10% loss on a $36,000 stock would mean about a $33,600 loss. Same thing is true with the synthetic. But in terms of percentages, this 10% gain or 10% loss, the percentages are going to be very different. Because if the upfront cost is only $1,000 and we make roughly $3,600, that's a very large percentage move. If we lose roughly $3,600 on a $1,000 upfront investment, that's a very big. So this is a very leveraged investment. So when would you do a synthetic? When would we do this? Well, we do it when our expectation is for a long synthetic, which is what we've been talking about. When you expect the stock to be going up, you're willing to be more aggressive, knowing it's more leveraged, and leverage can work against you, accepting some of the issues that I mentioned before, no dividends, no voting rights, expiration dates you got to deal with. In this case, the expiration date's out of ways. Assignment risk. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And, capital requirement differences. There we go. That's when you would do it. If you want to take a more aggressive stance. All right. So that's the trade. Now, let's look here. What about our Greeks? Well, look at our Greeks. If I were just to look at this, and let me get rid of the stock for a sec, and let me switch this because I want to be able to check. Is it going to let me uncheck? It's not going to let me uncheck one of those, is it? Okay. In any case, let's go and let's go to the, let's do this. Let me click here. Let's look at our theta, $2.83. Okay. $2.83 theta. That's time decay. Well, look, if I were just looking at this and going here and looking at my theta and I were to just look at here, my theta on my call, which is working against us, you see that's offset by the theta on the put, because that'd be positive theta on the put because it's a negative, it's a negative, um, we're shorting the contract. We're shorting the put, so the theta gets reversed. Okay. So the net, instead of a $7 theta on this, our theta is, what did we say? About $2 to $3 on that. So that gets reduced. Gamma gets reduced. Vega gets reduced. Okay. So there we go on that. So that's the long synthetic. Now, let me just see if there's anything else I want to mention on here. You're going to, in terms of expiration date, what we're going to do is we're going to buy as long as we expect to be in the trade. This is a longer term trade. Typically, we're going to do them out at the money contracts. In terms of management, you're going to manage them like you would a stock. If I'm doing a longer term trade, I'm probably not putting a super tight stop on it, loss on it. I'm willing to let it have some ups and downs, but at some point I may decide I'm going to get out of this trade. Let's say we say, you know what, I think this is a reasonable support level. I'm going to put this in as a support level. I want to get out if my stock goes below, I don't know, a little bit below here, 340 or less, let's say. Can I do that on the trade? Yeah, I can do that on the trade. So I'm going to go to my trade, and here's this. I'm going to create a sequential order. I'm going to right click, make it an opposite order. This green order is going to get me in. This is going to get me out. And I'm going to make it a market order, good till canceled. Click on the gear. What it's going to do is it's going to bring up a window. And I'm going to say, I want to get out if Visa marks less than or equal to 340. So there's my stop. Now, that may not be the only reason I decide to get out of this trade, but it's certainly a reason to get out of a trade. Let's go here on this. And we just did Visa. So this is the trade, and it's filled. Here's our exit on this. Typically on longer term trades, probably less commonly, we're not setting targets, particularly close targets on this. We could if we wanted to. Now, we'll see how this goes. If Visa goes up a lot, we'll probably do very well. If Visa goes down, we won't be doing so well. We had another synthetic I did in a different webcast here on this, on CSX. Notice, this is a synthetic. Long call, short put. How are we doing on it? Well, we're losing money. We're down $90 on this right now. When did we get in on this? Well, let's see. What did we got? We got in on the 5th. Okay. We got in a long synthetic on the 5th on CSX. CSX. Where's the 5th? We're down a little bit, so I'm expecting the stock probably went down. Here's the 5th right there. Can you see where I'm pointing? Let me zoom in. Is that this is the 5th right here. What happened? Well, the stock went down a little bit on us. Am I going to get out of this trade because it's gone down? No. As long as I'm still bullish overall, we're willing to stick with that trade. All right? But we're down a little bit. That's how that is. Now, let me just kind of, let's switch here for a second. Let's see, how are we doing? We're doing okay on time. But I want to talk about short synthetics, and let me just make sure. This moves like a stock, and you're going to manage it like a stock. You can set stop losses like we just did and just demonstrated. We're going to exit on a technical breakdown, if that's what we're going to use. Or for a longer term trade, maybe a fundamental breakdown. We were looking at Visa before was our example. Well, maybe Visa starts to have their earnings turns around, okay? And the nice growth that we've seen doesn't look so growthy anymore. Well, we may decide to exit out of it, okay? And at some point, we're probably going to get out as we get close to expiration. Remember, there is early assignment risk on this, okay? A little bit more of an aggressive trade here on that, okay? The buying power. So Abhi mentioned something. The buying power effect can be quite large on this, quite substantial on this trade. Because even though you're going, hey, it's only costing me $1,000 for this trade, like the one we just did, the margin requirement, the buying power, that the broker isn't going to say, oh, it's only going to cost them $1,000, because there's more than $1,000 risk on this. There's substantial risk on this. And therefore, you just need to be careful on that. Now, that's the main reason people do long synthetics, okay? So let's go and let's talk about short synthetics here, short synthetics. So remember, long synthetics are meant to simulate long stock. Short synthetics are meant to simulate short stock. So if you want, what you can do is you can go, well, I'm going to find a stock that's more bearish. What are we going to look for? Well, maybe something that's downtrending, something that you think is going to be more bearish. I'm going to call this, let me just zoom in here. I'm going to call this more of a technically bearish stock. We've got a 20 and 50-day crossover here. We're below both. Both are sloping down. The stock's below it. We have lower lows. We have lower highs. And so I'm going to call that bearish. All right. Now, again, you can choose your expiration date. How do we do a short synthetic? Well, we're going to sell the call. We're going to buy the put. I encourage you to practice this on paper money. Okay. So what I'm going to do here is I'm going to go to trade. I'm going to go out as long as I feel I need. Now, one thing is double check your liquidity. We can go to our open interest if we want and see actually a fair amount of open interest on these. I'm going to go at the money. Well, let's see. 65 is the closest we got here. In this case, I'm going to sell the call and I'm going to buy the put. I'm going to hold down my control key. What's my net cost on it? It's a credit up front, okay? It's a credit up front, $47 credit, okay? Now look, if I click on confirm and send, I'm not going to send it right now. I want to look at it first. But here's the thing, max loss, infinite, okay? Well, it doesn't require an infinite buying power effect. About $1,500 is the buying power on this. This assumes that you've been approved for this. Okay, you got to be approved. For long synthetics or short synthetics, you got to be approved. This goes against you more and more and more. The stock goes up. So have your exits in mind. The max profit may look great, okay, but realistically, remember, how do you achieve the max profit on a short synthetic? Well, if the stock were to go down to zero, it seems unlikely the stock's going to go down to zero. But potentially, if I'm bearish, this could turn into a nice trade if it goes down. Now, let me get rid of this, a little drawing. Let's analyze this trade. So we're going to analyze this. Let's do this. Let me just do this real quick here. Let me click on my bid price. Let's go to risk profile. If I were to short stock, this is what the risk profile would look like. You see that? Okay. If I were to do a short synthetic, this is what the risk profile would look like. Again, they look very similar. In this case, it's a little bit of a credit, as I mentioned. As we look at our are Greeks, again, they kind of offset each other. Theta, vega, gamma all become a lesser consideration, less drag or less benefit, if in the case of a positive thing, on the stock, excuse me, on the trade versus if you're just doing a single option, because again, they're largely going to offset each other. Our delta may not be 100 exactly. In this case, I didn't even notice the delta on the other one, but it should have been in the ballpark of 100. In this case, negative 100 because it's a short synthetic. But that's how that works there. Okay, so roughly 100, roughly 100. Okay. Now, question from RB Tech Trader: would it make sense to buy an out of the money put long to offset the short? You can add other trades on here, no doubt, absolutely. In the case of, say, a long synthetic, where our risk profile graph is going to look like this, and our risk is to the downside, we could buy an out of the money put or something on it to protect. In the case of a short synthetic, which is what we're looking at right now on the screen, could I do an out of the money long call to try and help protect? I could. Obviously, it's going to cost. Obviously, it's going to add some negative theta to the situation, but maybe it's worth it for you. But the same can be said, by the way, for stock. When you buy a stock, if you short a stock, that's the risk. You could look at potentially buying a call to try and help you if things were to go against you. Or if you're buying stock, you could always look to buy a put to protect you if it goes against you. So those are all considerations that you can look at on this. In the case, let me just talk about the short stock, okay? Obviously, if the stock goes up more, you lose more money, okay? Comparing it to just short stock, the potential benefit if the stock goes down, it's roughly the same. Potential loss if the stock goes up, it's roughly the same because they both have unlimited risk. In terms of dividends, one kind of nice thing is if you short stock, as the short seller stock, you can owe dividends. You may have to pay the dividend, okay? Not receive the dividend, you may have to pay the dividend. In the case of a short synthetic, it's not, you don't have to pay the dividend. These are just options you own, but you're probably at a greater risk of early assignment in that case as well. No expiration on short stock versus the option, and you do have assignment risk. Okay? So that's a comparison of those two. So why would we do this? Capital efficiency. That's one reason. Okay. Just realize that's not changing your risk. You still have risk. It's maybe a way, if you're comfortable with options. I don't want to say easier. It's a different way of getting downside exposure in case you have a bearish take on a stock. It's a little more flexible in that regard. And there you go. So, but one of the key things is I don't want you to trade this strategy or any strategy until you feel educated and confident in it. And that starts with your paper money there. Okay. So in terms of pros and cons, I just have a few pros and cons I listed out here. Let me just kind of go through this and make sure I got those. It can replicate stock-like directional exposure. You're using options though. It may offer some capital flexibility there with the less upfront cost on that. And easy to visualize here on this. And in the case of a short synthetic, it can avoid some of the mechanics of a short stock, of doing short stock, such as borrowing stock. Some stocks are hard to borrow, and you may not be able to do a short stock on that. But options do expire, right? And so this does have some different things, and tax treatment's different. I can't get into the taxes on these, but just realize anytime you do an option strategies, the tax treatment is different than with stock treatment. And if you're not familiar with options, this can be a little bit more complex, a few more moving parts that you got to think about on this. Now, so we did 2 examples. Let me give you one more example here. And I'm going to go back to a long synthetic for my other example. And my other example is going to be a shorter term synthetic, because the first one was a LEAPS. Okay, long term. Well, whether we're short term or long term, we're likely going to be looking at the technical analysis on these. Okay. And here we go. It's the stock, the trend's going up. This is Coke, KO. We seem to have a support level there. Great. You could potentially do it as a long-term investment, longer. But you could also do things like this and say, look, we kind of are, go up and then go down. We kind of go up and then down and up. And then this is kind of almost like a flag here with the flag breakout. Could I do something shorter term, not anticipating that Coke is going to be going up over the next 6 months, but maybe going up over the next 6 days or, 2 weeks or 3 weeks or something like that? Can I do that? Yeah, I can do that. So how far up? Well, kind of a typical type target that traders will use on this is what they'll say is, well, the length of the last move. Well, the length of the last move was from about 81 up to about 91. I'm going to go from the low. Okay. So from about 85 up to 95. And maybe you even go a little short of that. Just be a little more conservative even if it doesn't get up there. We can go up to 94 or 93, but we are going to want to be cognizant of our reward to risk ratio on that. If we enter this as it is right now, and the stock's at, I'm going to say about 88, and we decide we're going to stop out around 84. How did I come up with 84? Well, I'm calling this a support level, right around where the moving average is. I'm going to give it a little wiggle room below that, so a little bit below the 85 as well. But if I say 84 is where I'm going to get out, and we call that kind of a stop, keep in mind that doesn't guarantee we're going to get out of 84. Look, Coke could have a really bad news event come out, and this could drop down significantly further than that. Maybe it drops down to 75 or something. We're not getting out of 84 on a stop if it gaps down to 75. But if I do have my target price up, we'll say $95 or something like that, the difference between the 88 and the 84 represents $4. Okay? That's what we're going to call the risk. The difference between the 88 and the 95 is about $7. Okay? That's what we're going to call the reward. So that's when we consider reward or risk, that's the kinds of things that we may consider on this trade. Now, it doesn't need to be a certain ratio. Some people will say, well, I want this to be a 2-to-1 ratio or something like that. Well, hey, I would say most traders are going to say, I want something north of a 1-to-1 ratio. But, well, if you're a 2-to-1 person, that's fine. But just keep in mind that reward to risk ratio. So we said we're going to get out around 84. Okay. So here's what we're going to do. We're going to do a synthetic, but it's going to be shorter term. And therefore, when I'm doing this, I'm doing that shorter term. Actually, hold on one quick. Okay. let's go. I'm going to go out just 35 days here. So shorter term, remember, expiration date needs to match the time frame on this. At the money, 87.5 is going to be at their money. It's a long synthetic. Okay. So I'm going to click on ask for the call. I'm going to hold down my control key. I'm going to click on bid for the put. Make sure this makes sense. Same expiration date, same strikes. Basically, it's not going to cost us much out of pocket if we were to send this. There's still the buying power effect, of course. Max profit is showing as unlimited. Max loss is showing as very big. But we're going to actually put in 2 exits on this one. I'm going to click on first triggers 2 OCO. Actually, I don't even need to do that. I can just do a first trigger sequential and put on 2 exits on the same exit order. So I'm going to right click on this. I'm going to create an opposite order. I'm going to make it market. I'm going to make it good till canceled. And doesn't like that right now. Hold on. Once I put in my gear and go over here, what I can do is I can do that, make it good till canceled. And we're going to say if Coke marks less than or equal to 84, we're going to get out. Doesn't guarantee exactly what price it's going to get out at. Click on the line below it. If we mark greater than or equal to 95, we're going to get out. I'm going to save that. And then what we're going to do is we're going to review it. And we're going to look at that and see, okay, there we go. So this is a shorter term. Read it over, make sure you do that. And then we're going to, actually, let me edit this. I just want to make sure that gets in. Confirm and send. We now have another synthetic. What did we do? We demonstrated long synthetics, longer term look at it with our Visa trade. We did a leap, okay? We actually used a little looked at a little fundamentals in addition to the technicals, briefly. We did a shorter term long synthetic on Coke. That's what we just did. We also, I don't think I sent the trade, but we did a short synthetic. We modeled a short synthetic on Altria there. So there you go. Let me just see. Here's a few takeaways as we go. Make sure you're using start with liquid underlying stocks, okay? You're gonna use the same strike and expiration. Analyze it before you place the trade. Remember the risks. Remember you have assignment risk on that, early assignment risk. We're not gonna hold it all the way to expiration. You're gonna get out before that. You can use exit orders. You're going to manage these typically like you would a similar trade. If I'm doing a shorter term synthetic, I'm going to manage it more like I would do a shorter term stock trade. If I'm investing in a longer term leaps type synthetic, I'm going to manage it kind of like I do a longer term stock hold. Check out those Greeks and don't think synthetic means safer, because it's not. You still have the risks. There we go. I want to thank you for joining me. Next week, we'll hit up another topic in our series. James, thank you for helping out in the chat. I do appreciate you. I hope you all have a nice weekend ahead. And what we will do is we'll see you same time next week. Make sure you subscribe to that Trader Talks channel. If you like the webcast, there's a little thumbs up at the bottom of the page. If you click on that, I'd appreciate it. It helps to promote this on their algorithms there. So it does me a favor on that. Thank you very much, everybody. Have a great weekend. Bye-bye.